I'm going to be direct with you about something that keeps me up at night. Last week, I met with a couple, both 62 years old, both still working, both worried. They'd done everything the financial advisors told them to do. Maxed out their 401ks when they could, stayed invested through the ups and downs, avoided the worst mistakes, and after 40 years of work, they'd accumulated $500,000. Is this enough? They asked me. Can we retire on this? I looked at their numbers. At their current spending rate, adjusted for inflation, they'd run out of money by age 78, maybe 80 if they got lucky with market returns and lived frugally. That conversation haunted me because I've had versions of it hundreds of times over my career. And here's what troubles me most. These aren't people who made catastrophic mistakes. They didn't blow their savings on speculative ventures. They didn't panic and sell at market bottoms. They simply didn't have enough time to let compound interest work its magic. And now they're facing a mathematical reality that feels insurmountable. But here's the thing, and this is what I want to spend our time together discussing. It's not insurmountable. Not if you understand what I've learned about investing in the final decade before retirement. Not if you're willing to think differently than most people approaching this stage of life. I'm Howard Marks. I've been managing money since 1969. I've helped build Oaktree Capital into a firm managing over $170 billion. And I've spent the past 50-plus years studying how wealth compounds, how risk actually works, and how investors can position themselves to achieve their goals even when time is running short. What I'm about to share isn't some get-rich-quick scheme. I don't believe in those, and I never have. What I'm going to walk you through is a systematic framework for how someone over 60 with $500,000 can realistically target $2 million by retirement, not through speculation or luck, but through disciplined application of principles I've watched work across multiple market cycles. The mathematics are straightforward. To turn $500,000 into $2 million over 10 years requires an annualized return of roughly 14.9%. Over 12 years, you need about 12.2%. Over 15 years, about 9.9%. These aren't impossible numbers. The S&P 500 has delivered periods of 10% plus annual returns many times in history, but achieving these returns consistently, especially in the final years before retirement, when you theoretically should be getting more conservative, requires a specific approach. Let me start by addressing what most financial advisors will tell you at age 60. They'll recommend moving heavily into bonds. They'll cite the old rule of thumb, subtract your age from 100 or 110, and that's the percentage you should have in stocks. At 60, that formula suggests 40% to 50% in equities maximum. The rest should be in safe fixed income. I understand the logic. As you approach retirement, you have less time to recover from market downturns. A 50% bear market at age 35 is painful but survivable. You have 3 decades to make it back. That same bear market at age 65, right as you're about to start drawing income, can be devastating. But here's what that conventional wisdom misses. If you follow it religiously, you're almost guaranteeing that you won't hit your target. A portfolio that's 50% bonds yielding 4% and 50% stocks returning 10% gives you a blended return of 7%. At 7%, your $500,000 grows to about $985,000 in 10 years. You've doubled your money, which sounds good until you realize you needed to quadruple it. This is the trap I see so many people in their 60s fall into. They're simultaneously told they need higher returns to fund their retirement and that they should be getting more conservative. These two imperatives are in direct conflict, and most people resolve the conflict by accepting that they simply won't have enough. I reject that conclusion, but rejecting it requires understanding something fundamental about risk that most investors get backwards. Most people think risk is volatility. They think a stock that goes up and down 30% in a year is riskier than a bond that barely moves. But that's not how I define risk. Risk, to me, is the probability of permanent loss of capital. It's the chance that you put money into something and never get it back. By that definition, the safe 50-50 portfolio that guarantees you won't reach your retirement goals is actually quite risky. You're taking the risk of running out of money in retirement, which is one of the most significant risks you face. So, what's the alternative? How do you pursue the returns you need without being reckless? The answer lies in understanding what I call the risk-reward asymmetry, available to patient-disciplined investors. Throughout my career, I've found that the best investment opportunities share a common characteristic. They offer significant upside with limited downside. Not unlimited upside with no downside, that doesn't exist, but situations where you can make $2 or $3 for every dollar you might lose. Let me give you a concrete example from my own experience. In late 2008 and early 2009, during the depths of the financial crisis, Oaktree raised the largest distressed debt fund in history. We were buying the bonds of companies that the market had written off as doomed. These bonds were trading at 30 or 40 cents on the dollar. Everyone thought we were crazy. The consensus was that the financial system was collapsing, that we were headed into a depression, that these companies would default and bondholders would get nothing. The safe move was to sit in cash or treasury bonds. But when we analyzed the actual businesses, we found something different. Yes, they were stressed. Yes, some would default, but many were fundamentally sound companies that were temporarily unable to refinance their debt because credit markets had frozen. If they could survive the crisis, and we believed they could, their bonds would eventually trade back toward par value. We weren't making a macroeconomic bet that the crisis would end quickly. We were making a microeconomic bet that specific companies were stronger than the market believed. And we structured our investments so that even if we were wrong about some of them, the ones we were right about would more than compensate. That fund generated returns of over 20% annually for our investors, not because we were geniuses who predicted the future, but because we understood the difference between temporary distress and permanent impairment. Now, I'm not suggesting you should have been buying distressed debt in 2008. You probably didn't have access to those opportunities, and even if you did, they required specialized expertise to evaluate. What I am suggesting is that this same principle, finding situations where the risk-reward is skewed in your favor, applies at every level of investing. In 2025, as I look at markets, I see several areas where I believe this asymmetry exists. Let me walk through them systematically. First, consider the current state of large-cap technology stocks. I know what you're thinking. Tech stocks are expensive. They've had an incredible run. The Magnificent Seven have dominated market returns. Surely this can't continue. Maybe it can't. But here's what I've observed over my career. When a structural shift occurs in the economy, the companies that are positioned to benefit from that shift can compound value for far longer than skeptics believe possible. We saw it with the shift to personal computing in the 1980s and 1990s. We saw it with the internet in the late 1990s and 2000s. Yes, there was a bubble, but the underlying trend was real, and the surviving companies created enormous value. We're seeing it now with artificial intelligence and cloud computing. The difference between the dot-com era and today is profitability. In 1999, companies were valued on eyeballs and clicks, not earnings. Today's tech giants generate hundreds of billions in free cash flow. They have fortress balance sheets. They're not speculative ventures. They're some of the most profitable enterprises in human history. Could they decline 20% or 30% in a market correction? Absolutely. But if you have a 10 to 15-year time horizon, I believe the probability that high-quality technology companies with dominant market positions and strong cash generation will deliver double-digit returns is quite high. The risk isn't that these businesses will fail. The risk is that you'll pay too much for them or that you'll panic and sell during a temporary downturn. Second, I'm intrigued by what's happening in international markets, particularly in emerging economies. For the past decade, U.S. stocks have dramatically outperformed international equities. The valuation gap has widened to levels we haven't seen since the late 1990s. U.S. stocks trade at roughly 21 times earnings. Emerging market stocks trade at about 12 times earnings. Does that mean emerging markets will definitely outperform going forward? No. Valuation alone doesn't tell you when a reversal will occur, but it does tell you something about the probability distribution of future returns. At these relative valuations, the math suggests that international stocks have better long-term return potential than U.S. stocks, even if U.S. stocks continue to perform well. For someone in their 60s with $500,000, allocating 20% to 30% of your equity portfolio to international stocks, particularly in Asia, where demographic and economic trends remain favorable despite short-term challenges, could provide the additional return boost you need, while also diversifying your geographic concentration risk. Third, And this is less obvious. I think there's opportunity in what I call boring dividend-paying stocks that the market has ignored in its chase for growth. I'm talking about utilities, consumer staples, healthcare companies, businesses that generate steady cash flows, pay reliable dividends, and grow modestly but consistently. Why do I like these now? Because they've underperformed dramatically during the bull market of the past few years. Money has flooded into high-growth, high-multiple stocks. Meanwhile, a company that grows earnings at 5% to 7% annually and pays a 4% dividend has been left behind. But that company, if you can buy it at a reasonable valuation, gives you a 9% to 11% total return with much lower volatility than the market as a whole. For someone approaching retirement, having a portion of your portfolio in stocks that pay significant dividends serves two purposes. First, it provides income that you can either reinvest or use to supplement your living expenses. Second, it reduces your sequence of returns risk, the danger that you'll be forced to sell stocks at depressed prices early in retirement to fund your spending. But here's where most people go wrong with dividend investing. They chase yield. They see a stock yielding 7% or 8% and think it's a great deal without asking why the yield is so high. Usually, it's high because the market doubts the dividend is sustainable. The company might be overleveraged, or its business model might be deteriorating, or it might be paying out more than it earns. What you want are companies with dividends that are well covered by earnings, that have a history of maintaining or growing their dividends through economic cycles, and that operate in industries with durable competitive advantages. These companies might only yield 3% or 4%, but that yield is reliable and it will likely grow over time. Let me give you a specific framework for how I'd think about constructing a portfolio if I were in your situation, over 60, with $500,000 needing to reach $2 million before retirement. I'd start with the core, 50% to 60% in high-quality U.S. equities. This would be a mix of large-cap growth stocks with strong competitive positions and proven dividend payers with sustainable business models. I'd want exposure to technology, healthcare, and consumer businesses that have pricing power and can grow earnings faster than inflation. Then I'd add 20% to 25% in international equities with a tilt toward emerging markets where valuations are more attractive. I'd use low-cost index funds for this exposure rather than trying to pick individual foreign stocks, because I don't have the same level of insight into international companies that I have into U.S. businesses. I'd keep 10% to 15% in fixed income, but not traditional bonds. At current yields, bonds don't offer enough return to justify their place in a growth-oriented portfolio. Instead, I'd look at shorter duration, higher quality corporate bonds, or even preferred stocks that offer better yields with acceptable risk. And here's the piece that might surprise you. I'd keep 5% to 10% in cash or cash equivalents, not because I'm bearish or because I'm trying to time the market, but because having dry powder available gives you optionality. When markets sell off, and they will sell off at some point over the next 10 years, you want to have capital available to deploy at better prices. Some of my best investment decisions have come from having cash available when others were forced to sell. This isn't a conservative portfolio by conventional standards. You're 70% to 85% in equities when most advisors would tell you to be 40% to 50%. But remember what we established earlier. The conventional approach won't get you where you need to go. You're making a calculated decision to take more market risk in order to reduce the risk of running out of money in retirement. Now, having the right asset allocation is only half the battle. The other half, and this is where most people fail, is behavioral discipline. I've watched investors destroy themselves not through bad investment selection, but through bad investment behavior. They buy high when they're feeling confident and sell low when they're feeling fearful. They chase performance, jumping into whatever asset class or sector has done well recently. They overtrade, generating taxes and fees that eat into their returns. If you're going to pursue higher returns in your 60s, you absolutely must have the discipline to stick with your strategy through volatility. That means not panicking when your portfolio drops 20% in a market correction. It means not getting euphoric and overallocating to whatever is hot when markets are soaring. It means rebalancing systematically, selling what's gone up and buying what's gone down, even when it feels uncomfortable. Let me tell you about a mistake I made early in my career that taught me this lesson. In 1987, I was managing a convertible bond portfolio. The market had been strong all year, and by October, I was feeling pretty good about our positioning. Then came Black Monday, October 19, 1987, when the Dow dropped 22.6% in a single day. I watched our portfolio value collapse. I remember the physical sensation of panic, the tightness in my chest, the urge to do something, anything, to stop the bleeding. And I'm embarrassed to admit that I did sell some positions that day. Not a lot, but enough that I locked in losses on securities that, within months, had recovered most of their value. That experience taught me something crucial. The pain of watching your portfolio decline is real and visceral, but acting on that pain is almost always a mistake. The investors who did nothing on Black Monday, who simply held their positions or even better, bought more, ended up fine. The ones who sold locked in their losses and missed the recovery. I bring this up because if you're going to pursue the strategy I'm outlining, you need to prepare yourself psychologically for volatility. Your portfolio will decline at some point over the next 10 years. It might decline 30% or 40% if we have a serious bear market. You need to decide right now, while markets are calm and you're thinking rationally, that you won't panic and sell when that happens. One technique I recommend is to write yourself a letter. Explain why you're pursuing this strategy, what your goals are, and why you believe it's the right approach. Then, when markets are falling and you're feeling the urge to sell, read that letter. Remind yourself of the logic you applied when you weren't in the grip of fear. Another critical element is tax efficiency. If your $500,000 is in tax-deferred accounts like a 401k or IRA, you have more flexibility because you're not generating current tax liability when you trade. But if a significant portion is in taxable accounts, you need to be thoughtful about minimizing taxes. This means holding positions for at least a year to qualify for long-term capital gains treatment. It means harvesting losses strategically to offset gains. It means being careful about dividend-paying stocks in taxable accounts. If you're in a high tax bracket, qualified dividends are taxed favorably, but you still pay tax on them every year, even if you reinvest them. Over a 10 to 15-year period, the difference between a tax-efficient strategy and a tax-inefficient one can easily be 1% to 2% of annual returns. That might not sound like much, but compounded over time, it's the difference between reaching your goal and falling short. I also want to address something that makes many people in their 60s uncomfortable: continuing to work and save. I know the dream is to retire at 65 or earlier, but the mathematical reality is that every additional year you work has three benefits. First, you're adding to your savings. If you can save $30,000 to $50,000 per year, that's meaningful capital. Second, you're allowing your existing portfolio to compound for another year without withdrawals. Third, you're reducing the number of years your portfolio needs to support you in retirement. If you're 62 with $500,000 and you work until 70 instead of 65, you've given yourself 8 years instead of 3 to reach your goal. At a 12% annual return, $500,000 grows to $1.24 million in 8 years. Add in $40,000 of annual savings, and you're at $1.7 million. That's not quite $2 million, but it's close enough that with some additional return or some modest lifestyle adjustments, you can make it work. I realize that continuing to work isn't always possible. Health issues, job loss, caregiving responsibilities, there are legitimate reasons why people can't work into their late 60s. But if you can work, even part-time, the financial benefits are substantial. Let me talk about something else that's often overlooked: the power of geographic arbitrage in retirement. If you're willing to relocate to a lower-cost area, you can dramatically reduce your required income in retirement, which means your portfolio doesn't need to be as large. I've known several people who retired with what seemed like insufficient savings, but who moved from expensive coastal cities to lower-cost regions, the Southeast, the Midwest, parts of the Southwest, where their housing costs dropped by 50% or more. Suddenly, what looked like an inadequate nest egg became sufficient because their spending needs declined. This isn't for everyone. You might have family ties that make relocation impractical. You might love where you live and be unwilling to move. But it's worth considering because the difference between needing $80,000 per year in retirement versus $50,000 per year is enormous in terms of the portfolio size required to support it. Now, I want to address the elephant in the room. What if the market doesn't cooperate? What if we enter a prolonged period of below-average returns, like Japan experienced in the 1990s and 2000s, or like the US experienced from 2000 to 2012? This is a legitimate concern. Market returns are cyclical, and we've had an extraordinary bull market since 2009, with only brief interruptions. Valuations are elevated by historical standards. It's entirely possible that the next 10 years will deliver lower returns than the past 10 years. If that happens, you need contingency plans. The first contingency is to save more aggressively. If you can increase your savings rate from $30,000 per year to $50,000 per year, you're adding $200,000 to your portfolio over 10 years, even before investment returns. That's significant. The second contingency is to be flexible about your retirement date. If markets are weak in year 8 or 9 of your plan, you might need to work an extra year or two until conditions improve. This isn't failure, it's prudent risk management. The third contingency is to be willing to adjust your retirement spending. Maybe you don't need $2 million, maybe $1.5 million is enough if you're willing to spend $60,000 per year instead of $80,000 per year. The goal isn't to hit an arbitrary number, it's to have enough to live comfortably and securely. I want to be clear about something. I'm not guaranteeing that following this approach will get you to $2 million. I don't make guarantees about investment returns because I don't know what the future holds. What I am saying is that this framework gives you a realistic chance of achieving your goal, which is more than you'll get from the conventional approach of moving heavily into bonds and accepting lower returns. The key is to understand what you're doing and why. You're making a conscious decision to maintain higher equity exposure than traditional advice would suggest because you've calculated that the risk of market volatility is less than the risk of running out of money. You're diversifying across geographies and asset classes to reduce concentration risk. You're staying disciplined about rebalancing and tax efficiency. And you're maintaining flexibility to adjust your plan based on how markets perform. One more thing I want to emphasize: get professional help if you need it. Not from a salesperson who wants to put you into high-fee products, but from a fee-only financial advisor who can help you think through your specific situation. Everyone's circumstances are different: your health, your family situation, your other sources of retirement income, your risk tolerance. A good advisor can help you customize this framework to your needs. What I've laid out here is a template, not a prescription. You might decide you want to be more conservative, keeping 30% in bonds instead of 15%. Or you might decide you want to be more aggressive, going 90% equities. The important thing is that you're making these decisions deliberately, with a clear understanding of the trade-offs involved. As I think about people in their 60s facing this challenge, I'm reminded of something I've learned over my career. The best investment decisions are often the ones that feel uncomfortable in the moment, but prove right over time. In 2009, it was uncomfortable to buy stocks when everyone was predicting another Great Depression. In 2020, it was uncomfortable to buy during the pandemic crash. But those uncomfortable decisions led to exceptional returns. For someone over 60 with $500,000, pursuing higher returns by maintaining significant equity exposure will feel uncomfortable. Your friends who are moving into bonds will tell you you're taking too much risk. You'll feel anxious during market downturns. But if you've done the analysis, if you understand the math, and if you have the discipline to stick with the strategy, you're giving yourself the best chance of achieving financial security in retirement. That's what this is really about, not hitting some arbitrary number, but ensuring that you can retire with dignity and security, that you won't be forced to make painful compromises in your later years because you ran out of money. That's a goal worth pursuing, even if the path to get there requires taking some calculated risks. I hope this helps you think differently about your situation. The next 10 to 15 years of your financial life are crucial, but they're not predetermined. You have agency, you have choices, and if you make those choices thoughtfully and execute them disciplined, you can build the retirement security you deserve.